Good morning, good afternoon, good evening, whenever you are watching this week's video. We done made it to um we a little bit past a month in, right? Um Before the tax deadline comes for individuals. So we in here reviewing tax returns. That's what's going on over here. All right, we going hard so that we can get through what is on our desk, and there's a bunch on my desk, right? So that we can make sure that we hit the April 15th deadline with ease. Everybody know what's going on. Everybody feeling what they feeling. Everybody's getting their individual videos and will know where they stand and where they won't stand. Now, before I get into this week's video, I made a bet with my brother, my youngest brother, that I should not have made, because I have not been watching college basketball like that. So even though I talk a lot about chess and things of that nature, right? Like, the game I love to watch 100% is basketball. Like, I'm a basketball fan, y'all. I'm a basketball fan. We grew up. My dad coached my brother. Helped with my youngest brother when he played basketball. My youngest brother played basketball. My father did attempt to teach us basketball. That's another story for another day. I semi played, but absolutely loved the game. Absolutely loved the game. So much so that was it last year? I think it was last year. Last year, my husband took me to my first professional game. We had good seats. It was in DC. It wasn't an exciting game, but I was glad to have the experience, to say I had the experience, right? Um, and so I definitely love basketball, like old school, fundamental basketball. Girls play better fundamental basketball than guys. I can't say I'm really a big fan of how everything is played. Everybody shooting threes and stuff like that now, but I love a good basketball game. My two oldest sons, they play boys and girls club basketball. And then I've been the team mom. Like, that's really what it is. Like, I like basketball to that degree. I will cheer for anybody's child is playing. That is 100% me. So I say all that to say, my goofy butt was not paying attention. And even though my brother was giving me play by play, but as to what's going on in the MEAC as to get closer to, where we are into March Madness, I agreed to make this statement. So I'm looking at my phone because I agreed to tell y'all that I graduated from the evil empire, and my youngest brother graduated from the illustrious Mecca, Howard University. So now you can't say that I didn't say it. Now you don't watch my video. Yes, I done said it. Don't keep bothering me. Okay? Even though we know which one is the better school when it comes to playing basketball. So what? Y'all just won. But I'm going to cheer for the MEAC all day long. Y'all understand? Because it is what it is. HBCU experience is an HBU experience. And so all day, I'm going to cheer for HBCU. Okay? So that is that. That is out the way. Last week, I told you all that I would come back this week and I would talk statutes. Now I got to explain to you what a statute is before we go into our presentation for this week. And I, of course, when I get to putting it together, then I got to chop and screw this thing and be like, oh, I need to break this into parts. So a statute is a limitation of, is a statute of limitations, right? Is a time period established by law as to when the IRS can review, analyze, resolve anything related to your tax situation. Now, statute of limitations don't just apply to the IRS. They will apply to the state side, but we're going to focus on the IRS. Why? Because there's 3 statutes that are pertinent that we need to apply, pay attention to. Why? The IRS got a certain time period to assess your tax. That's what we're going to talk about today. The IRS got a certain time to collect the tax. We're going to talk about that next week because I got to chop and screw because you're like, what? It's different time periods. And then the IRS has, then you personally, us as taxpayers, you and me, have a certain time to claim a refund or a credit on a tax return. And the reason why we got here is because I needed to walk you through, okay, this is when they assess the tax. This is how long it takes to collect the tax. Now, this claim to refund or a credit is going to be crucial because that ties back to the article that I broke down for y'all last week. So this is why we're talking about the statutes, because you're like, why are we doing it this way? Assessment, collection, and then how many years before we can claim, what's our window for claiming a credit or a refund on some monies? And then I'll go back and then I'll tie it back to what the significance is to that case once we get to that final discussion. This week, we just going to talk about the time period to assess the tax. All right. So if that's good with y'all and y'all cool with it, right? I want us to do what we do. Let's get into the slideshow, shall we? Let's do it. Let's do it. All right. Let's go there. All right. Now, today we're going to just talk about the time the IRS can assess tax. Why? Because you need to know what that is. This is pertinent information. They only got a certain amount of time to assess the tax. What is it? The IRS generally can assess the tax in 3 years after the return was due. This includes extensions or after you file the tax return. The reason why I say this is because I might file an extension today, right? I might file an extension today, then turn around, and that means we don't, because now we're going to talk 1040s. Then we have until October 15th of this year, between 15 and 17, depending on if it's a weekend, to file that return. And if we do not file that return timely, right, then let's say we don't file it again until January 2027 when the tax software open back up or e-file open back up, because it goes down and then it'll open back up. So let's say you missed that deadline. We didn't file on time and we want to e-file. And so what happens is we wait until it opens back up. E-file opens back up at the middle of January 2027, and we don't file that tax return until 2027. Okay? I'm not even going to talk about if you owe or if you don't owe. We're just talking about how the IRS determines when they're going to assess the tax that on a return that was filed. Okay? They go by whichever is later. And this is why I use that example of due date is April 15th. We did an extension. That means it's due October 15th. That's a 1040. But for some reason, we don't finish and we don't file the return until January 2027. In that case, they can't assess, the IRS cannot assess any tax until we actually file that, right? This deadline is known as I messed that up for y'all. This known as the assessment statute expiration date, or ASAD. Understanding this helps you know rights and obligations when you're dealing with them, right? So what does this mean? The standard 3-year rule. How does this work? We're going to go with the example, even though I just gave you one, right? But we're going to go with example. The ASAD is the deadline by which the IRS must assess any additional taxes owed. After this date, that 3-year period, after that, they generally, and we're going to say generally, like a seasoning, okay? You can either pour heavy or pour light. Generally, cannot assess more tax for that return. The example, the return, and I'm going to use the same one. We just changed the date, right? 2021 return filed April 18, 2022, due date. ASAD is April the 18th, 2025. That's 3 years from the day we filed it. If we file it late, let's say we don't do it until the extension time period, but we filed that return October 31st. After the October 17th day, right? Now we got 3 years from that. They said they got 3 years to be able to come back and assess some tax, any additional tax, right? If you receive a notice about additional tax owed, it will explain, or it should explain, taxes, penalties, interest, and next steps. It's going to break it down, right? And that's what I need y'all to be looking for. When you get your notices, you need to be looking, because they'll give you this language on the front. They'll give you a number at the top, but on the back, normally on the back of page like 3 or 4, depending on how many pages it is, it'll say initial liability, tax liability. It'll give you a breakdown of penalties. It'll tell you interest. It'll tell you what was actually paid. So if you did any withholdings throughout the year, that's in a payment, right? So it'll tell you, hey, this is the tax that was assessed. This is additional taxes that's owed. This is any penalties. This is any interest. And they normally tell you what penalty you're getting, right? They'll do a code next to it. And then they'll say payment. And then there'll be a next step. If you agree with this, cool, don't do nothing. You know what I'm saying? But make sure you make a payment by this date. These are the ways you can make a payment. If you disagree, do the following steps, right? So definitely look at these notices and what they say, because that's going to be important. All right, next slide. There are exceptions to the rule. By law, the IRS can extend, they got the right to, or eliminate this assessment window. The IRS can assess tax at any time under the substitute for return program. Now, you like, well, what's a substitute for return? We're going to hear this again when we talk about collection. A substitute for return is, hey, you didn't file your return. You ain't do what you were supposed to do in a timely fashion. We believe you owe us. We're going to file the return. IRS going to file the return based off of the information they have. In a lot of cases, that is just your income information. They don't know if you itemized. They don't know if you if you had another baby. They don't know that, right? They're going to do it based off of what they know. It's a substitute for return. And as a tax professional, as an enrolled agent, when I'm looking at transcripts, I'm going to be looking for that. On your tax account, you'll see a SFR, and they can legally do this. Now, I'm going to tell you, in the last couple of years, I'm going to say since the Panini season, I haven't seen a lot of SFRs. I'm not saying they're not doing it. I just, from people that I've worked with, I have not seen a lot of SFRs. Filing your own return later, we turn the clock back on. And sometimes I'll tell people to do the clock. Sometimes I'll tell them, hey, we need to, I keep messing with this. Sometimes I'll tell them, hey, y'all, in order to reduce what this SFR say, I know it's going to turn the clock on. But we need to actually we need to file your real return, because what they got it's going to have you owing more money, right? If I'm looking at it in the SFR pretty right, I ain't going to touch it. But if there's, like I said, let's say you have more deductions. Let's say you had a business and they couldn't see that, right? And your business had expenses and it sent you into a loss. Let's say you had some more dependents. Then I'm going to file a return knowing that it's going to kick my time period down the field. I'm going to start that clock from the time we filed it. Because remember what we said, they got 3 years to assess that tax and do any additional taxes, either from the due date of the return or when the actual return was filed, whichever is later. See if that makes sense. I know sometimes we don't like it, but I believe it's going to put you in a better situation financially from what was reported on a tax return. I'm going to do what is better for you. Underreported income by 25%. Now, I told y'all, this one of them penalties I hate. I hate the underreported penalty because that thing is nasty. Underreported income by 25%. If you reported 25% or less of your additional income, the assessment window extends from 3 to 6 years. Because they like, hey, maybe you underreported somewhere else. All right. Agree to extend. You may sign a statutory waiver to extend the assessment period. You can negotiate the extension or refuse to sign it. Now, if you filed a false or fraudulent return with the intent to avoid tax, and we talked about evading tax versus avoiding tax a couple weeks ago, the IRS can assess tax for an unlimited amount of time. If you out here doing dirty, they like, hey, you don't follow regular people rules. You out here doing stuff dirty. All right? So those are the exceptions to the rule, because always there's an exception to somebody's rule. When is the clock suspended? Certain events pause the 3-year assessment period. I'm going to go in reverse with bankruptcy. Bankruptcy filing, the assessment period is suspended when a notice of deficiency is issued. Less than 90 days before you file a bankruptcy petition, the same day or after filing and before the automatic stage terminates. This period is further extended by time allowed by law, meaning you kind of put yourself in a holding pattern here when you go into bankruptcy, because now you're going to turn my clock off for that 3-year assessment window. What did we say the true point of an assessment window is? A said, hey, they can't come back and assess no tax after this time frame. That's why you got to pay attention to them notices. That's why you got to know when you filed your tax return. That's why last week when we were talking about, hey, well, did he file in time? Did Wong actually defend his position in time? Because they looking at these statutes to make sure that if you did it, that your clock didn't run out. And we know under the case with Wong, the situation really is that we were under a window of penalty. Well, we were under a panini where we were under a dire disaster. People just coming in my office. We were in a disaster we are in a disaster situation. And so therefore, remember, January 2020 to July 10th, 2023, that opened a window back up for us because, hey, now we might can come back and get some credits, some penalties, some things that we couldn't have because our time periods, it's going to get into collections and it's going to get to when we can ask for a refund. But now we can go back because now our windows have opened up. That's why these statute time frames matter. And that's why you need to be like, wait a minute, they keep assessing tax. How many times can they send me a letter for this same tax return saying that I owe them more tax? That's really what we're asking here. All right. Then we're going to go to the first one. Notice of deficiency, a 90-day letter. The suspension starts the day after the IRS mails the letter. And y'all know we got issues with USPS and mailing and dates and all this kind of stuff. That's for another day. And ends 60 days after the final court decision. You have 90 days, 150 days if you, I'm sorry, y'all, I'm messing with this mouse. 150 days if outside the U.S. to agree or petition the tax court. If you do neither, the IRS will assess the amount shown plus penalties and interest, and it's gonna be what it's gonna be. All right. And finally, what you need to know. And here are the statutes and publications. We'll make sure you get links to them. Just in case you're like, wait a minute, okay? I don't know how good y'all can see it. Remember, we just talked about the assessment date. How long does the IRS have to assess tax? Depends on what's going on, right? Standard is 3 years from the date that you either filed a return or when it's due, right? But there are exceptions. Remember, if you did fraud, it's unlimited. If you didn't do if you got to do a substitute for return, we opening ourselves up. If you sign a waiver, you asking for more time, we can do what we got to do. They can do what they got to do. If after we are looking at a substitute for return, we come back and we say, you know what? I want to file an actual return. We've now added more time to our window for when they can assess that tax. Okay? Biggest takeaways. The IRS only has a certain window to assess the tax. Assess the tax. Meaning, A, you calculated it, you said it was this. You could easily, and I'm going to give you a totally different situation than you owe money. Let's say you got a refund. They went back and kind of reviewed the return and was like, you forgot something. That's where underreported come in. Or we looked at it and the software calculated something wrong. You now owe us where before you did not. And the stakes will get you big time. Whether you catch it or they catch it, they're going to come back and they're going to hit you with some interest and penalties. And you're going to pay that tax you were supposed to pay. I know because I've done it where I snitched on myself and said, oh, I did this wrong. Let me go on and correct it. Nobody caught it. Let me Go and correct it before y'all catch it and y'all give me more interest and penalties. And they still slap interest and penalties on you, girl. But they could have came back in that period of time, right? Because IRS got 3 years. They could have came back in that period of time and said, nah, you still calculated wrong. You now have additional tax. Or the opposite side of that is you calculated it wrong. Your tax really should be lower than this. You overpaid. You will see that sometimes. Hey, something was wrong. Your system glitched. The calculation in your software was wrong. You paid this. You really only owed this. Now, you may be wondering, well, what's going on? And so now I'm going to tell you, people may be trying to figure out what happens. I'm going to use the state level. When you start looking at why is it 2026 and I'm getting notices from 22 and 23, you within that window. You'll start to see it too for the IRS. Why am I now getting letters between this year and this year? Hey, something's wrong. We got to make sure it's right because they got a certain amount of time to assess this additional tax. You could have spent that refund. I promise you. It's people who have done it. If something seemed off and we looking at, I'll tell people don't cash that check. Or if you do cash the check, put the money somewhere else. Because once we figure this out, we're going to go back and get them the check. We're going to go back and get them the right amount of money that they were supposed to have. And then we'll let them come back and assess any interest and penalties. Because now we paid it and you want them to do the calculation. This is the first statute. The IRS has a certain window to come back and assess additional taxes. But it's for a period of time unless you fall under the exception. Next week, we're going to talk about the collection statute. Why? Because that collection statute, said matters. And I'm not going to tell you what doesn't. It doesn't. Like when we really trying to get to the nitpicky and doing resolution situations and we like, nah, IRS, y'all wrong. Y'all outside of that window. You couldn't assess this tax. You snooze, you lose. Like if we trying to build a case that way, it's important. But a lot of times we see stuff from where people are trying to figure out payment plans, if the tax is going to fall off, etc. That collection statute is where I see a lot of people coming to me that have not, who've been in payment plans for years. And they're like, when is this going to go away? So we're going to talk about that one next week. But I also want you to remember this because I do have people who are coming to me who are like, I have not filed my taxes in 3 years. I haven't filed my taxes in 4 years. I haven't filed my taxes in 2 years. Once we file that return, that is when our ASED date starts. So let's say I'm filing a 23 return in 2026 and I filed your 25 return. Understand the clock ticking for both of them. We got 3 years from the time we filing in 2026. So even though it might have been a 24 return and you like, oh, that's easy. 24 return should have been done in 25. I got till 2028 for them to assess tax. No, we late. We are late. So therefore, that clock runs different because we're late. We are filing this in 2026 as though it was a 2025 return. So knowing when you filed, knowing what year it was, knowing why you didn't do what you did, that's where the ASED comes in. And it's imperative that you understand this statute and how it works. And what we call it tolling the date, right? How bankruptcy and other things will put a pause on that assessment date and why. Why it's going to add more time to it down the road. Okay? If you got any other questions, anything like that, please let me know. I did have a client come and ask me this, and I'm going to go ahead and end this with this. She asked me how long, well, if that's the case, then how long I have to hold on to my tax returns that I've been prepared. Like, how long should I hold on to my stuff? How long should I hold on to my documentation? Normally, I tell people you want to hold on to them for at least 3 years. I say at least 6 to 7, just because now you see we got dates where they could come back and be like, wait a minute, I didn't put that in there. Let me go look. Right? I have stuff back to the 2000s, and because I used to prepare the tax return by hand and then put it in the software because I didn't want to see because I was crazy. Okay, but I will tell you that if you're trying to downsize, right, and you're like, I got all this kind of stuff, and you're not comfortable, put it somewhere that's on a secure drive, right? You don't necessarily have to keep the hard copies. I would tell you, scan it, put it somewhere where it's on a secure drive that you know you can get to if ever needed. But you really don't have to. You got, I'm gonna say, a window of 3 years, 6 years max. So if you looking and you like, I'm trying to clean up in my house and I don't want no smoke, and they didn't come and ask me no questions from, and I got returned from 2001, you should be good. You should be good. They got your transcript. They got all this kind of stuff if you ever need it. But because I like to hold on to paper. I'm crazy, right? I will keep an electronic copy somewhere. So don't be afraid to scan it. But do you have to keep the hard copies and all this kind of? You don't. If you're trying to clear up space, feel free to clear up space. Feel free to clear up space, because now you know, oh, they can't come back and assess no additional tax. They're not going to come unless there is a crazy reason. They're not going to come back and assess any additional tax on a 2001 return unless it fits one of the exceptions. We out of that 3-year assessment date. Y'all see how I brought that together? All right, y'all. I hope you're having a wonderful week. I am getting ready to get back into the throes of these tax returns, and I will talk to you later. Last week, we did not do a podcast live. We did not go live. This week, my intent is to go live. Last week, forgot what was going on. I think I was just coming out of the fog because I knew I had a deadline, and that's what my focal point is. This week, we're going to go live between 12 and 1, and I'll talk to you then. Till next week when we talk about the collection statute. Peace, y'all.